In today's video, we are going to study a simple market scenario in the 4-hour time frame of the Australian dollar versus the US dollar. We're going to talk about the details of using raw price action reading, a little bit of the advanced types of divergence in the relative strength index called fractal divergence, and simple lines as well. We always begin the analysis by looking at the major and minor highs and lows in the chart to get a feel for the market trend. Analyzing the trend using major and minor highs and lows is the simplest way of understanding what buyers and sellers are doing. It's a lot better than using other types of indicators like moving averages or the MACD to determine the trend, because these indicators have a lot of lag built into them. In other words, by the time these trend indicators show a possible trend reversal, it's because price action has already reversed many bars ago. In other words, if you rely on these types of signals to determine the trend of the market, you are more likely to miss the high-quality reversals that can only be observed with raw price action in alignment with other subtle tools. In this chart, we have a pretty easy situation to deal with. In the price action jargon that I use in my courses, this is called a running flow, where major highs and lows are very well defined, and you can see that price is oscillating in a sort of predictable way. Here we can see that price made a higher high in the major flow. That renders the low in between the two major highs as a solid major low. The logic behind that is that if buyers are able to surpass the last major high, it's because the demand zone out of which they came is powerful enough to be considered in future points of the analysis. In summary, we know that in a major solid low there will be buyers that might be strong enough to display some sort of reaction in the near future of price. You have to keep in mind that this reaction might not be enough to reverse price, but it's definitely one of the key elements that can help nudge price enough to produce a significant reversal. The possibility of a significant reversal will depend on the existence of other factors as well. It's important that you understand that solid major and minor highs and lows contain a lot of information about possible future reversals. Any solid high or low contains a supply and demand zone, but this zone varies a lot in size depending on what happens in the transition between the price vectors that form the market extreme in the first place. The most objective way of determining the upper and lower limits of a demand zone in this case is by using the inward and outward frequencies that compose the market extreme in question. That would be the more mechanical part of this demand zone identification, but there is another side to that as well, which is more subjective and nuanced. In this chart, we have a great example of that. Observe that we have a bullish candle that opens with a small gap down. Buyers quickly fill that gap and form a strong bullish candlestick. The logic behind that is that for some reason, price opened with a gap down, denoting some sort of selling power. However, buyers were very quick to counteract that and immediately filled the gap. The moral of the story is that this is a subjective indication of buyers' dominance over sellers. Notice also that this happens inside the boundaries of the demand zone that are marked by the inward and outer frequency lines. We can even narrow down the demand zone by grabbing the upper and lower limits of the small gap down. One problem that might arise here is the confusion between major and minor highs and lows. Observe that a few candlesticks after the creation of the demand zone, we can see the same pattern of a high surpassing a previous high, therefore rendering the low in between as a solid low. It's important to develop a sense to detect the difference between major and minor market extremes. Notice that the first low we saw belongs to a much larger price movement, while the second low belongs to a smaller one. In other words, the first low belongs to the major flow of the market, and the second low belongs to the minor flow of the market. It's precisely the counterpoint between major and minor flows that allows the trader to pinpoint the high-quality price reversals. This would explain, for example, why the demand zone in the minor flow was disrespected entirely. When price came down, the major bullish flow was already exhausted at the top, so sellers entered the arena to produce their part of the movement down. However, in a minor flow, buyers were not exhausted yet. So long story short, when the major sellers collide with the minor buyers, it's more likely that the sellers are going to win simply because the major flow has more power than the minor flow, except in very specific situations that are outside the scope of this video. Price ends up returning to the major demand zone highlighted before. To know if price is going to reverse to the upside or completely ignore the demand zone, we must observe the counterpoint between the major and minor flows. If both flows start to agree, we have the possibility of a significant reversal point. In terms of the major flow, the major sellers have produced a retracement, so they are not as strong as they were at the last major high. Beyond that, price is now sitting on the demand zone that produced the last major high in the first place. In other words, if price is going to rise in a major flow, this is the place where it's going to do so. In terms of the minor flow, there's a lot of headroom between the current price level and the last high, and most importantly, we have an indication that the minor flow will go up with the appearance of a fractal bar in a major demand zone. Notice how the lower tail of the fractal bar touches the outer frequency line, pierces the smaller zone determined by the small gap, and closes on its upper range, showing that there are indeed buyers in this level. You can see that both major and minor flows are pointing in the same direction. Another detail that helps in this scenario is the fact that the relative strength index is showing a continuation divergence between the low that produced the demand zone and the current low. That also agrees with the trading context we have so far. A possible entry would be a market order at the open of the next bar with a stop below the lower tail of the fractal bar. In terms of target, we want to keep a 1-to-3 risk-reward ratio in mind. Since this is a running flow formation, we can use simple lines to make future projections. We can do that by simply connecting the two most important major lows so far, and then extrapolate a line with the same angle to the major high in between to project an upper limit for the extension of major buyers. The target will follow the upper line. Notice that this gives us a 1-to-3 risk-reward ratio trade, roughly speaking. So let's see how the market develops. Here we can see that price goes straight up to the extension line, rendering this trade as a winner. This is exactly the sort of trade that allows an equity curve to grow consistently, not only in the short term, but in the long term as well. If you want to learn how to trade using these techniques and many others, check out the courses I provide in the video description. You can visit my website fractalflowpro.com to see more details about the table of contents of each course and the testimonials from students. If you enjoyed this type of video and wish to support the channel, please click the like button, subscribe to the channel, activate the notifications, share the video with your trading community, and leave your feedback below in the comment section. Don't forget also to check the other videos in the channel. Thank you very much for watching, and I hope to see you in the next videos. Take care.